Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, the Governor of the Bank of Canada on this week's decision on interest rates and the path for the Canadian economy from the bank's point of view, plus measuring the economy in real time. A new tool offers a grim outlook. That's all ahead. First, for the week that was in business, it's time for the briefs. The Bank of Canada lowered rates by a quarter percentage point this week, as was widely expected. Now sitting at 2.5%, the bank said while it's mindful of the path of trade talks and the cost of tariffs, the recent weakness in the economy, especially jobs, prompted the move. It also noted that shifting to new trade partners brings with it higher costs. Inflation in Canada rose 1.9% in August, slightly above levels in July, but below expectations. The annual rate has been affected by the cancellation of the carbon tax, which lowered the cost of fuel. Excluding gasoline, inflation slowed to 2.4% in August, below the previous 2.5%. While prices remain firm, they are not accelerating. The U.S. central bank lowered rates this week following weaker jobs data and a slowdown in parts of that economy. The Federal Reserve also flagged inflation that remains elevated, but the central bank is expected to lower twice more this year. The federal government is allotting $13 billion to build thousands of affordable homes across 6 cities. Build Canada Homes is the newly created federal housing agency that will oversee projects, including 4,000 factory-built homes on federal land, with capacity to increase the number of units to 45,000. $1 billion will be spent on transitional and supportive housing. A data breach at Canada's investment industry regulator potentially exposed everyone from financial advisors to executives to traders. The Canadian Investment Regulatory Organization sent out notices to registered clients, alerting them that their personal data might have been breached on August 11th. Information access could include names, addresses, email addresses, birth dates, and place of birth. Home sales were strong in August across the country, according to the Canadian Real Estate Association. The volume of sales hit a 4-year high as 40,257 homes changed hands. Prices were more muted, gaining 1.9% year over year and declining slightly from July. The national data also smooths huge regional differences, with big price increases in Saskatchewan and Quebec and declines in Calgary, Vancouver, and Toronto. And those are your business briefs. With all eyes on the Bank of Canada this week, here's a look at rates and inflation by the numbers. At 2.5%, interest rates in Canada are neither high nor low, depending on how you look at it. Rates hit a high of 5% in 2023 and 2024 as the bank moved to contain high inflation. Back in 2022, prices in Canada rose 6.8%, which was a 40-year high, driven by supply chain shocks related to the pandemic and the war in Ukraine. While inflation cooled slightly by 2023 to 3.9%, the bank kept rates high to make sure prices came down. Then in June 2024, the bank started lowering to 4.75% that month, ending at 3.25% by the end of the year. After hitting 2.75%, the bank held there for several meetings. While inflation was cooling, it was not entirely in the bank's target range of 1 to 3%. Wages, in particular, were showing inflationary pressure. Fast forward to this week, inflation is still running close to the 3% on some closely watched measures, while there are growing signs of potential recession, and you have the makings of a very complex rate call. That complex decision-making was very much in evidence this week as the bank made its call on rates. Tiff Macklem is the governor of the Bank of Canada. I spoke with him on this week's episode of the Wonk podcast. Here's our conversation.
Well, look, uncertainty is still elevated. And, as you understand very well, monetary policy can't undo the effects of tariffs. We can't reverse that. The only thing we can do is try to help the economy adjust to a new trade relationship with our biggest trading partner and make sure we keep inflation well controlled. Canadians are still, they remain concerned about the cost of living. And, our job is to worry about that for them so they don't need to worry about the cost of living. And certainly that's what we're focused on. Coming to the complexity, because it's a very sectoral shock, it's very complicated. The tariffs have been, they've been on again, off again. It's been a little more stable lately. That does mean you really got to look at this from a risk perspective. And the decision to cut today really reflected the fact that the risks had shifted. The economy is weaker, as you mentioned, while there's some mixed signals. inflation does look a little more contained. And against that background, a cut was appropriate.
You mentioned, of course, and again, this uncertainty of what happens with tariffs, not in your hands. It's still very much an unclear picture of where this goes. So you do have these scenarios of an escalation of the problem and a de-escalation of the problem. So just let's talk about, we don't know likelihood of those two things, but sitting here today and you're looking at the Canadian economy, the question a lot of people want to know is, are we sliding towards recession? We got that contraction in the second quarter. There's a concern about it. What's your feeling about which direction we do go?
Well, as you said, it's going to depend a lot on what happens with tariffs. The simple arithmetic of it is that 25% of our GDP is exports to the United States. We are very integrated with the United States. What happens with U.S. tariffs has a very big impact on our economy. If tariffs stay roughly where they are, that would be the current tariff scenario that we put out in July. We were expecting a sharp contraction in the second quarter. In fact, it came out at negative 1.6. We were monitoring negative 1.5. So it was very much as expected. And we saw a very sharp drop in our exports, down 27%. That partly reflected the fact that businesses in the first quarter pulled a lot of those exports forward to get ahead of the tariffs. So that boosted first quarter GDP. Of course, that unwound sharply in the second quarter, and you saw this big drop. Going forward, if tariffs stay roughly where they are, we are projecting a recession. We're projecting slow growth. Something around 1%. It's not going to feel very good. It's slow growth. And it's slow because the economy needs to adjust to this new reality, this new trading relationship, this new trade friction with the United States. Why is growth not negative? Well, we expect exports we don't expect a lot of growth in exports, but we don't expect a further big decline. We are seeing some consumption growth. You saw a little bit of recovery in housing. So we think that'll be enough to get some modest growth. But as I said, it's not going to feel very good. And then there are other scenarios. If there was a significant escalation of the tariffs, yes, you could see another negative quarter or two. So yes, that would be a recession. Hopefully, if we can de-escalate some of those tariffs, that recovery and growth will be better. These new tariffs, the unpredictability of our relationship with the United States, I think, is underscored for businesses. Is yes, they need to look for new markets. It's been very easy to export to the United States. It's gotten a lot harder. Businesses are now putting more effort in figuring out how to get product to new markets, how to develop those markets. And as you said, that all has some cost.
Coming up, more of my conversation with Bank of Canada Governor Tiff Macklem. Stay with us. With growth slowing but inflationary pressures remaining, how worried do we need to be about stagflation? And how can a central bank help fix what ails the economy? Tiff Macklem is governor of the Bank of Canada. Here's part of my conversation with him on the Wonk podcast this week.
Well, I don't know. I grew up in the 1970s. So, to me, stagflation is like double-digit unemployment, double-digit inflation. That's nothing like what we have today. I don't want to minimize the difficulties we have today, but I mean, inflation is, latest readings, 1.9%. Our measures of underlying inflation are about 2.5%. Okay, it's not right on our 2% target, but this is low inflation. And the unemployment rate, yes, it's gone up, and particularly in the trade sensitive sectors, we've seen significant job losses. But it's 7.1%. It's not double digits. So stagflation is not a word I would use for this situation. We are in a situation where there's there's downward pressure on the economy and some upward pressures on inflation, but I wouldn't call that. I would not call it stagflation.
Fair enough. One thing we are dealing with, you alluded to it, the Prime Minister called it a rupture, and that is this sea change in how we think about our economy. And that is, of course, governor an economy that already had some issues before all of this began. Our productivity isn't where it should be, hasn't been for a long time. Our business investment has been lagging. A lot of those, of course, are things that would be best addressed by the government, by fiscal policy. You said today monetary policy is a blunt instrument. You do what you can, but they do work together. And I'm curious for your thoughts on Canada's potential success at making this pivot.
Amanda, we've been I think all of Canada really has been concerned about our weak productivity growth for some time. And there are things that we can do in this country to lower the cost of doing business, to make our economy work more efficiently. We don't need, U.S. tariffs to do those things. But maybe there's something about now that the cost of doing business with the United States has gone up, maybe we need to get more focused on reducing the cost of doing business in Canada and get more focused on reducing the cost of getting our goods to overseas markets. So we've been talking about a number of these things for some time. And I am pleased to see both at the federal level and at the provincial level, we're having more concerted discussions and policy initiatives than we've seen in many years. And so, what are some of those things? Well, if it's more costly to do business with the United States, why not reduce the cost of doing business in Canada? And you're now seeing the federal government, the provincial governments really start to come to grips with our own interprovincial trade barriers. Many small regulatory differences across Canada, across provinces. And the more we can take a comprehensive approach to this, the easier it's going to be for businesses to do business across the country in a seamless way. Provincially, we've got different labor accreditations for many professions: lawyers, accountants, electricians, nurses, doctors. If we could mutually recognize those, we could have one labor market in the whole country for all these professions. So those are some of the things we can do. The other part of it is, as I mentioned, you go back to, we learned painfully in 2008-9 around the global financial crisis just how dependent Canada's economy was on the U.S. U.S. banks failed. They went into a terrible recession. Our banks were okay. Our financial system was okay, but we got sideswiped in a very big way by the U.S. recession. There was a lot of talk coming out of that of the need to diversify markets, to diversify our exports, but we actually haven't accomplished much. I think now, though, I think businesses are waking up to the fact that yes, we have a new reality with the United States, and we do need to develop those markets. Part of that is improving our east-west transportation and building port capacity so we can get the goods to those markets. And there are a number of projects under discussion that would help to do that. So, from our perspective of monetary policy, these are ultimately decisions for elected governments, provincial governments, federal government. From the perspective of monetary policy, why do we talk about these things? Well, the more that we can improve the efficiency of the economy, the more we can grow the economy's capacity, the faster the economy can grow without creating inflationary pressures. That would be good for Canadians.
The question of affordability is still the one that most Canadians have front and center, even in the context of this massive fight we're having with our biggest trading partner and this change that's upon us, like it or not. Most people care that their day-to-day costs are still too high and that they can't afford a home, which is true for people that don't already have one. In terms of kind of anything that can ease that, obviously, people care deeply about what you're going to do next because they want to know about the path of mortgage rates a lot of the time. But on the affordability question, are we doing enough? Is there something else that could happen to make lives a little bit easier for Canadians?
Well, look, unfortunately, tariffs have made everything harder. Tariffs mean increased trade friction with the United States. It means the economy is going to work less efficiently. So what does that mean? Well, sadly, that means that, it means there's some added costs. It means that our incomes are lower. So, if that's the only thing that's happening, cost of living is not going to be getting any better. It's going to be getting tougher. So, and as I said, monetary policy can't really undo the effects of tariffs. It can't reverse that. Structural reform could. And what is that? It's the things we were just talking about. It's reducing interprovincial trade barriers to grow our internal market and reduce the cost of doing business in the country. It's getting rid of some of those regulatory differences. It's speeding up regulatory approvals and reducing regulatory uncertainty so that businesses who have investment projects can get moving with those and increase the capacity of the economy. I mean, fundamentally, if we want to improve affordability, we need to have an economy that is where productivity is growing faster, where we are more competitive globally. What does that do? Well, that will grow our incomes. And if we grow our incomes, then things become more affordable.
Tiff Macklem is governor of the Bank of Canada. I spoke with him on the Wonk podcast. Coming up, a new tool does a better job of measuring Canada's economy in real time. That's still ahead. But first, two iconic brands are merging their loyalty programs. Canadian Tire's Triangle loyalty program will extend to Tim Hortons customers. Launching sometime next year, the reward program will tie purchases at Tim's to rewards at Canadian Tire, which has already partnered with other Canadian companies like Petro-Canada and Royal Bank, with a WestJet partnership set to land in the coming months. The Triangle program has 12 million members. That is an awful lot of double-doubles. We're back after this. The Canadian economy is showing signs of fragility, and now the Canadian Chamber of Commerce has a real-time data tool to measure it. Andrew DeCapua is principal economist at the Canadian Chamber of Commerce. Thanks for being with us, Andrew.
Of course. Thanks for having me, Amanda.
So this tool is, unlike some of the other measures we get, which can be really sort of in the rearview mirror in some ways, is designed to give us a current snapshot. How do you think people will use it?
Yeah, so BDO Now, is a nowcast, and essentially it incorporates a large number of economic indicators. It forecasts what the next data point is for each of those economic indicators and adjusts its forecast based on whether it got it right or it got it wrong. And so, as economists call it, those upside, downside surprises. It operates just like a forecast, but it's purely model driven. And, in times when we're in the business cycle where we could be at these pivotal turning points, tools like this, which we hope are, accessible and of course are free to the public, can, of course, add to the arsenal of tools for businesses and the general public to make better business decisions. One of the interesting things about BDL Now is that it's always on, it's updated as the new incoming data comes in, and we really allow you to peel back how each economic indicator affected the forecast. So we updated our model yesterday, and our model is expecting the economy in the third quarter to grow 1.5%, and it included the latest wholesale trade data as well as manufacturing data and adjusted accordingly.
Yeah, which is so valuable because, of course, you're left with the last impression. It's that we had had this contraction in a quarter and people are worried very much that we're heading into recession. This would give businesses a slightly different viewpoint. Would you expect it to start to show up in your business confidence data and therefore you might even imagine in your business investment data?
Yeah, well, one of the great things is that there are 45 indicators in this tool, covers a large swath of, the Canadian economy, everything from CPI to GDP to consumer spending, and includes the survey data that you mentioned that is really important in getting a sense of business confidence, consumer confidence, includes purchasing manager indices. And so the higher frequency data makes the estimations much more accurate. And as you mentioned, we had a very sharp contraction in the second quarter. BDL now estimated a contraction of about 1%. We ended up being about 1.5%. Bank of Canada got it a little bit better, but of course, the better information we have, the more benchmarking we can do, businesses can make better decisions.
And as you said, it's free. People should check it out. Andrew, we do appreciate you joining us for this.
Thanks very much, Amanda. Thanks for profiling.
Andrew DeCapua is principal economist at the Canadian Chamber of Commerce. Time for the takeaway and the sum of the whole. As Canadians wait for a federal budget in a month or so, we got a timely reminder about how the math works in Canada. This week, BC said its provincial deficit is sitting at a record $11.6 billion, set to rise next year. Meanwhile, Ontario is projected to have a deficit of more than $14 billion. Like the federal government, provinces are spending heavily on new initiatives to help businesses and consumers affected by the trade war. But also, like the Feds, most provinces headed into this crisis already in the hole. That's the thing about running deficits. If your spending gets ahead of your income and you aren't willing to increase your income, in this case taxes, there's only one path back to balance, and it's not more spending. Maybe deficits seem like a remote issue, and most Canadians preoccupied with their own affordability problems are content to ignore it. But consider that a taxpayer in a high-debt province has a combined debt, counting both federal and provincial, that most definitely will affect them. Government debt comes at a cost to the government, of course, and in the form of new borrowing. And the more borrowing required, the more the market tends to demand in interest. When government interest rates rise, so do all other forms of interest. So while the central bank can fiddle with the rates at the front end of the curve, it's the debt further up the chain that will determine your mortgage rate. In other words, over-indebted governments hurt citizens today, not just in the future. And while we like to separate our provincial picture from our federal one, there is only one taxpayer, and that would be you. Of course, in times of emergency, spending may be called for. The pending federal budget will be full of items aimed at long-term gain and responding to a massive change in our situation. Fair enough. But a rainy day fund really only works if we aren't spending it on sunny days, too. My takeaway? Maybe this doesn't feel like the right time to hold governments to account over deficit spending, but we should at least be aware of the price we're paying. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.